Good afternoon, everyone. Thank you for coming. Uh, my name is Andre Mudikdo from Oriana Private Wealth. On behalf of my colleagues, Sean Rattray and Matthew Jones, we'd like to welcome you to this webinar today, which goes through the Australian federal budget and what it means for Aussies abroad. As you know, you've probably heard by now anyway, or even before the budget announcements, there has been a lot of conjecture, speculation in terms of what will be included in this budget and how significant the changes will be from a tax perspective, especially for those that reside overseas like you and I, and whether we'd need to review our plans when it comes to our Australian-based assets. So Sean, Matt, and I are here to disseminate the budget proposals, hopefully being able to distill the more important pieces or the more pressing pieces when it comes to tax reform and the impact on any type of property investments, etc. So for you to have a bit more clarity in terms of what's happening, and hopefully also have a call to action in terms of reviewing your properties, reviewing your portfolio, I'm sorry, and actually speaking with us to see whether anything needs to be changed or if we need to review the strategy that you have in place. For the next 45 minutes, Sean, Matt, and myself will go through the content of this webinar. I will go through more of a high level, if you like, view of the background around the budget proposals in terms of how Australia is doing as an economy, what are the priorities of this budget, and also some of the key budget updates as well. Matthew Jones will then take over from me and go through a few of the superannuation updates. As you know, superannuation in Australia is an extremely tax-effective platform that you can use for retirement planning, etc. So Matt will actually go through a bit of an update in that piece. He will also go through some case studies, how we look at how the new proposed tax reforms in the area of property, family trust, will interplay real time. So how will it actually work if it actually is going through, if it actually will be put through as legislation. Then we will have Sean Rattray from Australian Expatriate Property Home Loan Group, and he will go through a bit of an update in terms of the Australian property scene, as well as the opportunities to purchase property from an expatriate perspective. We'll close up the webinar with some Q&A, if you like. There has been some questions that has been sent through prior to today, which we'll hopefully be able to attend, as we'll go through some live questions as well, time permitting. But if nothing else, we'd really like you to take away the fact that, for all intents and purposes, if you do hold Australian property portfolio, if you utilize things such as family discretionary trust, or plan to return to Australia for that matter, the landscape has really changed, and it's really worth your while today to go through our presentation and just have a review of how this will impact you. So in the interest of time, I'll go through my part first. Hope everyone can see the slide. So in terms of, I guess, the background of what, how Australia is actually doing as an economy, the way I'd like to see it is by looking at how the government views the economy at the moment, right? And two of the key indicators, if you like, are employment and inflation, right? Employment being the main driver of the economy, as well as inflation, which obviously looks at the price increases and how comfortable people are in meeting their living expenses. The blue bar in this slide looks at the outlook at the mid-year of last year, 2025, what the government looks at, what the economy looks like at that point. And the orange bar, on the other hand, looks at what the government's view is today and what they have based their budget proposals on. Right, so there's, from a timeline perspective, it's around 6, 7, or about 10 months difference. But you can actually then see, especially in the inflation side of things, a stark difference in how the government views the economy. From the employment perspective, it looks quite stable, right? From the forecast and what the present outlook looks like, it's around 4.2, 4.5, which is extremely good from an OECD perspective. Other countries would have it around the 5% mark. So we're actually punching above our weight in terms of being able to, manage employment, if you like. Now, this might sound a bit contradictory to what you and I have heard on the ground, right? In terms of there have been redundancies in Australia. It's hard to find a suitable role. Graduates are finding it difficult to find roles of university. But the major driver of the government's outlook is the fact that net migration intake is still very high, right? And this net migration intake is what's powering really the employment market, as there are a lot of people or more people contributing to the economy in terms of their presence in Australia. On the other hand, the inflation is a concern from the government, right? As you can see, especially in 25 and 26, where around mid-year last year, their outlook of inflation is around 3.75. It's shot up to 5, and there's no, unless you've been living under a rock, you have probably heard of why the inflation rate is quite high. Obviously, the main instigators being the global volatility, the Middle East conflict, and the increase in price of oil and petrol, and the outlook going forward. The government sees this as a major concern and has put a lot of effort in being able to manage this particular point as part of the budget going forward. Now, in terms of the priorities, right, this time around, as you know, the budget comes out every year. The first one is what I've just spoken about, a response to the global oil shock and how the economy is actually doing. Now, how they were going to do that is by really, spending a strong amount of the budget to things such as protecting the supply chains, boosting fuel supply, and making sure that there are packages out there to help people meet their living expenses, such as the fuel, reducing the fuel excise, etc., etc. So really short-term and instant assistance to the population to be able to manage the oil shock now and in the next 12-24 months. I'll skip the second one for now, but the third one, taking pressures of Australia, linked to the first one as well in terms of responding to the external shocks, if you want. The budget also aims to take the pressure of Australia in terms of meeting their day-to-day expenses, such as providing the workers with the workers' tax offset, increasing funding in the areas of hospital care and PBS, the pharmaceutical benefits. So really trying to assist Australians in meeting from every aspect, meeting their living expenses. Making our economy more productive. Now, this sounds like more of an ongoing theme, right? Because I think any government would have this as an objective, right? So how they're doing it with this budget is really by trying to slash red tape. They identify that bureaucracy is one of the laggards, if you like, of the growth in Australia, as well as upgrading the energy infrastructure. So that hopefully will also have a positive effect to how the economy is moving going forward. And making the budget stronger and more sustainable. Now, this is probably more of a priority for them because, the reality is, right, Australia always been seen as the lucky country, but we can't always depend on our revenues on from natural resources, which is the backbone of, which has been for a long time anyway, the backbone of the government receipts, if you like. So they were now looking at more avenues to provide or generate tax revenues, and even looking at things such as long-established policies in the area of property and family trust, or those type of passive structuring issues, and see if they can manage or reform those tax. I shouldn't say tax plays, but those tax outcomes from those sectors. Okay, because that's also going to provide a bit of a buffer, if you like, in terms of the tax revenue going forward. So those are the priorities, if you like, of budget 26-27. I'd like to also point out, right, at this stage, it's all proposals, which means that it hasn't really gone through to legislation. But once it does go through, there are certain start dates, if you like, of when these proposals will come through. In terms of the second one, delivering tax reform for workers, business, and future generations, this is a bit of a clue on where the focus of this government is. The focus really is on young wage earner workers in Australia, as opposed to focusing on wealth accumulators or people that are relying on income from passive investments such as investment properties. One of the other reforms that they're really looking at is the intergenerational property equity. They are concerned in terms of the property market that there's less and less chance for young first home buyers to enter the market due to this prevalence of investment property owners or speculators that's really tilting the market a bit when it comes to market prices, etc. So they have made a few changes or proposed a few changes in terms of how capital gains or income from property can actually be used from a tax perspective. So that's one of their priorities, if you like, in terms of providing the younger Australians that wants to have more equity in the property market. So some of the key initiatives that the government has in terms of their spending is as such. Defense spending, 53 billion, which is around 2 or 3% of the GDP, which is par for the course. It's around the same. If you want to have a comparison, the US GDP, defense spending is around 4%. Obviously, their budget's a multitude of hours, but it provides the same type of proportion. Other type of spending goes to things such as fuel cost relief and fuel security, which is part of the fuel resilience package that I talked about. That's around 13.6 billion. Tax offsets for working Australians. That's an instant $250 annual tax offset from July 27, and also things such as funding and pharmaceutical benefit schemes. In terms of the key taxation measures, and this is probably where a lot of you will be interested in, or where most of the conversations have started now with this budget, is these three pillars, right? And the background there is quite appropriate. The first one is capital gains tax, right? So for a long time, capital gains, if you held an asset for more than 12 months and you sell the asset in Australia, and you're a resident of Australia, mind you, you get a 50% discount. Very simple, right? You bought something at $100, you sell it to $200, you hold it for 12 months, you got a 50% discount on that capital gains that's going to be taxable. They are now getting rid of that. Now they will have a cost-based indexation method, and whatever's left in terms of the capital gains is taxed at a minimum of 30%. Right. So if you bought something at $100, 10 years later, you bought it at $200, again, an example, they will index that $100 cost base to what it is now, right? And then you reduce what the sale price is and arrive at a gain, a capital gain. That capital gain will be taxed at 30%. So it's obviously a big departure, if you like, from the discounted method that you and I have been used to. There are certain exemptions, such as new property built, and this particular change goes live on 1 July 2027, assuming that the legislation comes through. From a property perspective, negative gearing occurs to when your expenses of maintaining a property, right, interest rates, etc., interest repayments, etc., is actually more than the assessable income you're getting from that property. Where currently you can actually offset that against other income that you have, say, for instance, your employment income or income from your share portfolio. Going forward, losses related to existing properties can only be deductible, or you can only offset the losses against that property itself, or from the properties that you own, and carried forward against other income from just that property. So it's actually now isolated. You can't actually use losses against other income that you currently have, which is a big departure as well. Right? That residual tax loss going forward, though, can also be added to the cost base when you do sell that property. So there is definitely a marked change, if you like, on negative gearing strategies going forward, and how that actually impacts what you are trying to achieve. The other one is more from a structural perspective. Currently, if you hold a family trust or a family discretionary trust, one of the benefits of doing so is being able to channel income from that trust to different beneficiaries who have different tax circumstances, right? What's being proposed and will be live from 1 July 2028 is that if you are, disbursing income from a family trust, the trustee will be paying tax at 30% first up. Any difference then will be able to be distributed down to the beneficiaries, and the beneficiaries will be taxed at their level, and being able to provide some kind of rebate or reduce it by the initial tax that's been paid out. Now, Matt will actually go through a case study on this to provide a bit more numbers and clarity on how it works. But suffice to say that the use of family discretionary trust now is quite different. Where previously, if you're on a high marginal tax rate, it becomes an arbitrage, right? Depending on what the other beneficiaries are, you can channel income. Now, there's actually a bit of a leveling of playing fields, if you like. Remember, 30% is also the company tax rate. So now income is taxed at 30%, and then it's distributed out. Certain trusts are exempt, and rollover relief for 3 years is available for, say, small businesses that wants to revert back to different type of structures to avoid this particular arrangement. Okay, so those are the three main pillars of the tax reforms, if you like, from this budget, and each of them would have a significant impact for you that invest in property, or those of you that actually has a family trust or planning to have one. I'll actually now bring Matt Jones into the conversation, so he can actually go through some of the super updates as well as going through some of the tax reform proposals.
Thanks, Andre. Hoping for a smooth transition here. Hi, everyone. Hopefully that's coming through and everyone can see that. Okay. All right, so thanks, Andre. So yeah, look, welcome everyone. I guess while the budget was relatively quiet this year, which is a welcome change on new superannuation measures, a number of significant changes do actually take effect from 1 July 2026 through previously legislated law and indexation. So I'll speak to the strategy opportunities a little bit later in the slide deck, but here's a high-level breakdown of what's changing from 1 July this year. So the concessional contribution cap is being increased to 32,500 per annum. That's from 30,000 per year. This cap covers all pre-tax contributions, including employer contributions and salary sacrifice arrangements for residents in Australia, but importantly, or personal contributions claimed as tax deductions for non-residents as well, who are looking to offset Australian property income and gains. So what this also means is for catch-up concessional contributions or carry forward contributions, members with total super balances below $500,000 at the end of the prior financial year can carry forward any unused concessional cap space for previous years, up to 5 previous years. So this cap indexing, or the annual cap indexing to 32,500 this year, basically increases this maximum potential catch-up opportunity to 175,000 from 1 July, utilising those previous years' unused caps. So that makes this strategy increasingly valuable for those with taxable income to offset. That can be capital gains, really large amounts of rental income, at least for the year that you're looking to utilise this strategy, or other taxable income such as employment income following a potential return to Australia. Non-concessional contributions caps, so they've indexed as well, bringing it up to 130,000 from 1 July. That's up from 120. These are after-tax contributions, and they don't generate an additional tax deduction for the contribution, but they do allow members to grow their super balance in this tax advantage superannuation environment compared to your personal marginal tax rates upon returning to Australia, which, as we're seeing, are becoming more challenging to do tax efficiently. Importantly, with members with super balances above the transfer balance cap, you're not eligible to make further non-concessionals, but I'll touch on that in a moment. The bring forward provision, so that's basically where you're triggering the bring forward provision and making a maximum of 3 years contributions in one go. Very useful strategy if you're repatriating back to Australia or just looking to really build that your super balance up very quickly. And the transfer balance cap itself. So this is basically the limit that you can transfer into the tax-free retirement pension phase. So that's indexed from $2 million to 2.1 from 1 July. This is a critical threshold as it determines both concessional contributions to a degree and also bring forward non-concessional contributions as well. So on to the next one as well. So Division 296, which was all the news in the previous budget. So this is arguably the most significant change this coming financial year, I would suggest, with respect to superannuation. So Div 296, just explaining what that is legislation enacted with an additional 15% tax on superannuation earnings for individuals whose super balance exceeds $3 million. The tax applies to proportion of earnings attributable to the balance above this $3 million, effectively creating a multi-tier rate structure within superannuation. And for those with very large super balances exceeding 10 million plus, the more recent amendment to the Division 296 legislation was that they've imposed an additional 10% tax, bringing the total tax rate within superannuation on these portions of fund earnings above this top tier to 40%. So significant and something you need to consider. So members, particularly with those larger balances, should be reviewing their structures and contribution strategies and whether Division 296 specifically creates the need for any restructuring considerations from 1 July, ideally before. So as mentioned, yeah, look, I'm sure everyone's socials are lighting up and there's plenty of negativity around the 3 big budget announcements being introduced, the removal of the 50% CGT discount, changes to negative gearing, and changes to how discretionary trusts are taxed. However, the devil is always in the detail on budget night, and there may be some silver linings to how these changes are applied specifically for non-residents. And actually some small wins here as well as we read through the detail. I've got some work examples I'll just go through in a moment as we've unpacked how these key changes are applied specifically to non-residents. However, before I do, as I know it always comes up, in short, and it did a lot in the questions coming through, but in short, again, there were no mentions of the previously tabled changes to Australian tax residency rules. Unfortunately, no further updates for you there, but we do continue to watch this space. However, it does look like government are forging ahead with the foreign residence CGT overhaul, which includes broadening the definition of taxable Australian real property, which you are subject to tax if you're invested in as a non-resident, with more asset types with close economic connection to Australia being caught up in this tax net. But reach out if you've got questions on that. And also the SMSF active member test. So I guess any non-residents, you can't be setting up SMSFs while you're a non-resident, but anyone that may have had one prior to moving abroad. The budget papers have confirmed the government still does plan to relax the residency requirements for SMSFs and small APRA funds by extending the central control and management tests from 2 to 5 years. Just provide some flexibility for those temporary moves overseas, and removing the active member tests for both types of funds. So the budget papers did mention that they are aiming to increase flexibility for those that are temporarily overseas. But this is a really complex area with some pretty punitive implications if you make any mistakes. So again, reach out to us if these are things that you need to be considering. Okay, so on to the case study, or first one here. So firstly, just starting with the changes to how capital gains are taxed. As mentioned earlier, the changes affect CGT, not just on property, but all asset classes. However, as non-resident investors in real estate, we are subject to Australian tax, so it's worth discussing. From 1 July 27, 50% CGT discounts for individuals, trusts and partnerships is set to be replaced with an inflation-based cost indexation and a minimum 30% tax on the net capital gains. So just stepping through this, firstly, how this affects Australian tax residents. So simplistically, this example shows a purchase 1 July 27, which is when the CGT rules commence, or the new rules commence. I've got just a property here purchased for $1 million, sold for $2 million 10 years later. Assuming current marginal tax rates for Australian residents here on the left remain the same, if you will, and then having a look at the effect with the matrix here on the right, which is just to purely demonstrate the old rules versus the new rules and the potential difference in tax outcomes here. So let's look at the first column here, if you will, showing the current rules now being abolished from 1 July 27. So you've got $1 million gain, applying the 50% CGT discount here. You've basically got this 500,000 assessable gain at marginal tax rates. So the first row here, let's just assume marginal tax rate for the sellers. Let's assume multiple owners pay tax at the top marginal tax rate. That equates to a total of 235,000 tax on the sale of that $2 million property. Now moving below that here, again, like I said, assume multiple owners, and looking at the lowest marginal tax rate possible here, which is 16%, Australian tax residents. And then you're comparing that with the 30% floor on the right, and this new effect of indexation, so changing from the 50% CGT discount to this cost-based inflation. So basically applying CPI here, I've just assumed 3%, applying 3% over 10 years. Basically, it increases that cost base, and then you're left with a net real value that's accessible and taxed. And again, just comparing these two tax rates, you can see here that the top marginal tax rate, it still makes a significant difference. You're going to be paying more tax because you're going to have less of a discount applicable. But importantly here, if you're at the 16% marginal tax rate, this 30% minimum floor now applies. So pretty significant there. Consideration for those selling properties. Now that's as Australian residents. Now I'm just going to step through what this looks like for non-residents. Now, as a lot of you are probably aware, since the 8th of May 2012, the CGT discount was removed for non-residents in Australia. So we couldn't claim this CGT discount anyway. So no big change for us here in that respect. Further, as you can see here on the left, non-residents, we have this minimum 30% tax rate in Australia. So we don't benefit from the lower tax thresholds. 30% is where we start. So again, this introduction of the 30% floor doesn't make it hugely detrimental for us as non-resident investors. However, again, it's early, it only came out 2 days ago, but reading through the budget papers, they don't specifically refer to non-residents, interestingly enough. So it would appear that the non-resident CGT position may actually improve given the new indexation measures, because at least I guess the way that we interpret it is that this new / old pre-CGT system of inflation-based cost base indexation, it does look like this actually will apply for non-residents moving forward, investing in Australia as well. So basically, this actually provides us a discount where there previously wasn't one before. So again, like I said, early days, but does actually look somewhat positive, if you will. So in this example here that I've just worked through, there's a lot going on, but basically in the blue here, we've got that same $1 million sale, $2 million sale with $1 million gain. Under the current rules, no discount applied. You can see the effect of the tax there, just assuming no other assessable income for the year, sell the property 1 July, if you will. And then under the new rules, with the new added benefit of the cost base indexation, we receive this discount to the assessable income. So you can see here, we've got this deduction that we didn't have before. So in a funny world, it looks like we may have actually got a little bit of a win there. So looking at the negative gearing from 1 July 27, as Andre mentioned, negative gearing for residential properties will be limited to investments in eligible new builds. For residential properties acquired after the budget night on Tuesday, investors will no longer be able to deduct net rental losses against salary and wages and other income. Previously, that was a nice little strategy for residents, of course, but even for non-residents, as we were able to accrue these carried forward net rental losses while they accrued offshore, and then could be applied later as Australian tax residents, usually getting used up pretty quickly in that first year of employment income. Will become an Australian taxable resident again. You can apply these carry forward losses to any income. So as Andre mentioned earlier, this is now constrained or ring fenced, whatever term you want to use, to property basically. So basically just this simple example here, just it shows some of the old rules. You've got $100,000 of salary. Got net rental losses, 10K. Basically, you could use that to reduce your salary. A lot of people like using that. Now, you basically can't do that. But as mentioned, that loss can be carried forward to be used against property down the track. Excuse me. So as mentioned, the new rules basically limit this carry forward loss to property to be used against property. So you can still utilize the losses if that property is either sold or, basically what was spoken to a lot is, over time properties basically become positively geared as you pay down the loan or you get more rental income. So, the modeling was all about, people are going to use these losses up at some stage against this property or other properties. So again, stepping through this, how it works, you've got rental income of 25,000, expenses 35,000. You get the net loss there, so you can still carry this forward. If either rents rise, property turns positive, you can use this carry forward loss, if you will, to reduce taxable income, or as mentioned, if you sell the property or other property you can utilize this carry forward loss there as well. So again, it's not this terrible outcome. You don't lose the benefit to apply these losses completely. It's just this negative gearing strategy where you use it against your salary. So, and of course, new builds are an exception to this to these new measures as well. So again, just breaking that down a little bit there for everyone on the line. So you're not going out and panicking and fire selling just properties and things like that. So plus you've got time as these new rules transition as well. So this other one basically around trust tax outcomes. Actually, in all of this, I think this is probably the most punitive. It does, I would suggest, probably affect a small segment of the Australian population, albeit the very wealthy. Within sort of the Australian landscape, but from a non-resident perspective, Australian trusts never really worked great from at least an income tax perspective, as income distributions are taxed at the top marginal tax rate for any non-resident beneficiaries. The situation is obviously even now more punitive as the changes to CGT. The other things that we've explained here earlier will actually be applied in the trust too. So it's really put a pin in some of these strategies. But where the real kicker is basically the income splitting capabilities as a resident is now reduced significantly with the introduction of this minimum 30% tax rate for distributions, as Andre outlined earlier. This was a commonly used strategy for streaming trust distributions, particularly to corporate beneficiaries in Australia, which doesn't really work. And I'm just going to step through that now. There's a lot going on. Just going to check time. So there's a lot going on here, but just sort of like looking through this. So the proposed rules, as mentioned, it looks like they're specifically designed to target these sort of splitting strategies, and in particular corporate beneficiaries. So an individual will receive basically, I guess if you're jumping into these examples, we've got scenario one. You've got 100K of income distributable. Basically, the trust pays this new 30% tax, and then the net's passed on to the beneficiary. The beneficiary in this case is earning $210,000. So the net distribution is added to their marginal tax rate, or taxed at their marginal tax rate rather. But they do receive this offset of the 30K or the 30% that's already been paid. So they just have to pay the additional. And the net outcome there on this 100K is they basically pay 47%. So the 30% paid within the trust, and then they receive a rebate and they pay the difference. So for a high marginal tax rate, there's no different there streaming to an individual. Now, scenario two, this is where a lot of people would use sort of like a non-working spouse, adult children. So you can't distribute to minors, but adult children, if they're not working yet, they're at uni, you could sort of use that to split the income as well. But let's just assume we've got, let's say, no other income. So you've got this tax, this low marginal tax rate, or in some cases no marginal tax rate that you could stream income to. So obviously you would pay less than, Sarah would pay less than Tom in this example. However, we've got, in this example, if there's a 0% marginal tax rate, you could stream and pay zero tax on that. But we've got this new 30% minimum tax rate within the trust. So in this case, the trust pays 30%. The net is passed on to Sarah. She doesn't get a rebate though, or anything. So basically she's left with the net, and the net outcome is that you're paying this 30% minimum tax now on trust distributions. Now, scenario number three, a little bit complicated, but in a lot of cases where you had both working spouses on the top marginal tax rate, or we've run out of low marginal tax rate beneficiaries to distribute stream income to, it will go to a bucket company, and a bucket company had a top marginal tax rate of 25% or 30%. However, with this now 30% tax at the trust level, that gets paid. Then the net distribution is paid to the company. The company tax rate is applied at 30% again on that basically on that net 70% that's been paid out, or 70,000 in this case, bringing that total combined double tax to 51% in this example. Then, if you want to go and spend that money personally, you've got to pay that from the corporate to the end individual. Well, then you're going to get taxed again. So basically, it looks like this strategy was specifically targeted in Australia and doesn't really work anymore. So tightening the screws. So look, moving away from the doom and gloom there and jumping into some of the tax efficient strategies that remain available. Firstly, superannuation. So keeping in mind that Australian tax residents are taxed on worldwide income. You can't really hide your wealth anymore like that. So, working through this and, trying to bring down that marginal tax rate. As mentioned earlier, we've got the 32,500 concessional contribution, which is used to reduce your taxable income in any year. You've got the benefit of those catch-ups. So you can actually make these contributions while you're a non-resident to superannuation. So, for instance, if you've got positively geared income on rental, if you do sell your property, or even like your previous home or something like that, as a non-resident, you're taxed, then, this catch-up provision becomes quite useful and effective. What we often look at for people that are repatriating to Australia, usually sort of in their 50s, they're getting closer to accessibility. You can basically start to move your personal wealth into this more tax efficient environment here. So the limit is 130,000 per annum. It's not a lot, but you do have this bring forward provision where you can do 3 years in one go. Then we've got UK pension rollover, small business, CGT, retirement exemption, other types of contributions as well. I don't have time to go into right now. But the end outcome here is, for a lot, and this is sort of the cornerstone for a lot of retirement strategies in Australia, is that you can essentially commence an account-based pension from this superannuation balance, which not only converts all income and gains within the superannuation environment to tax-free for the rest of your life, essentially, notwithstanding, those earlier higher balances that I mentioned under Div 296. But from age 60 and retirement, you can basically convert this, optimize the tax on your superannuation wealth for partners and spouses. If you combine that, it's a large amount. And then you can actually draw a tax-free income stream from superannuation as well. So this still stands to reason that it's the most tax efficient way, typically, for most people to save for their retirements in Australia. But you can also start doing this while you're a non-resident as well. So not to be overlooked. Now, I'm just going to fly through this pretty quickly. Now, in recent years, successive Labor and coalition governments have tightened domestic tax rules. They've reduced contribution caps for superannuation, making it increasingly more difficult to utilise these traditional onshore strategies and structures, as we've sort of gone through today. Conversely, offshore investment strategies have remained completely untouched. Similarly, the specific legislation governing domestic investment bonds, Section 26H, 26AH of the Income Tax Act 1936. It has not undergone a dedicated review or structural overhaul since its inception, preserving its original tax advantages. So really quickly, private placement or investment bonds, common name. They're a sophisticated form of investment-linked insurance, which has concessional tax treatment with the ATO. This can be very specific, have very specific tax advantages. You can structure all sorts of wealth in there, from ETFs, bonds, etc., shares, contributions, initially uncapped, subject to the 125% contribution rule. Some specific rules here, so come and speak to us and understand how this can be used. And then there's also other strategies such as foreign super as well that can be utilised. All right, just trying to get through that. Took up a bit of time. Sean, I'll at this stage throw to you. Thanks, everyone.
Thanks, Maddie. Cheers, Andre. Appreciate the intro. Let me just get my slides up. Give me one moment. Okay, let's kick off. In the interest of time, I'll try and scoot through this as swiftly as I can. As Andre mentioned at the start of the chat, I'm from Aussie Expat Home Loans, a mortgage broker based in Asia. We've got offices in Hong Kong, Singapore, and 2 in Melbourne. We pretty much exclusively help expats enter the property market and access lending solutions. We're a sister company of Oriana, so we have a lot of mutual clients. Anything loan related, reach out and we can help. Okay, let's kick off on rates. So interest rates, quite a bit different to this time last year. We've seen 3 interest rate increases over the last 12 months. This has brought us back up to a rate climate similar to that of January 2025. So RBA rate, cash rate currently sits at 4.35. We're seeing investor bank rates around about the 6.25%, 6.5%. Owner rock, probably around about 6 or 5.75. The RBA has indicated that it does intend to hold rates for now and monitor the inflation movements. They haven't ruled out any increases if they can't get inflation under control, but the big 4 banks' general consensus is they're looking to hold for 2026. And as long as inflationary pressure comes off over the next 12 months, then potential reductions into 2027. Okay, so what does this mean for borrowers? It's always important to review your current rates. Make sure you're not paying too much. If you are paying more than 6.5%, please do get in touch. It's always worth doing rate reviews on your existing loans. Banks are starting to price into their forecasts, into their fixed rates, the interest rate forecast. So we are seeing some favourable fixed rates for the 2 and 3 year periods. The good thing with fixed rates is it can provide some certainty when there's turbulence, which we're seeing some more macro factors impacting rates. Property, so we've seen some crazy numbers with property. It's more split now than we've seen it really at any other point. Prices nationally up around 10%, 12 months to date. Perth by far is the standout. Year on year growth, we're looking at house prices, a price growth of around 26%. 5-year growth over 91%, which is just crazy. Forecast for Perth that it'll continue to grow around 13% for 2026. Brisbane, once again, some macros as to why we are seeing year-on-year growth. There's a lot of domestic migration up north. The Olympics are coming, major infrastructure spends. We've seen 20% year-on-year and another 11% forecast. Adelaide, the trifecta, Brisbane, Adelaide and Perth, that's been 14% year on year, once again driven by population growth and housing undersupply. Sydney has been tempered, still see really strong numbers coming out of Sydney in terms of purchase price. It's a very tightly held market, but we're seeing longer clearance times, lack of quality supply. It's creating a bit of a vacuum for investors. And then at the bottom of the property clock, we've got Melbourne, very soft at the minute. Prices down 12 months for the last 12 months year on year. Macros for Melbourne, though, they remain strong. It is a long play. It's a patient play. It's going to be the biggest capital by early 2030s. It's still got the highest net migration. There's a lot of reasons why it will come back. It's by far the most undervalued capital in the market at the minute. So we're seeing a lot of buyers agents turning their focus to Melbourne and regional Victoria. National vacancy rates for rentals is really low, 1.6. Rents are up 5.7% over the last year. We anticipate that's going to blow out even further, in terms of year-on-year growth of rental return with the changes to the budget. For investors, that is good news for borrowing capacity, unfortunately at the expense of renters. But yeah, from a capacity perspective, it's only going to help. Okay. On the supply side, the government in this budget is all about new builds to increase stock. That matters for expats as well as domestic borrowers, which I'll talk to on this next slide. Now, I don't want to drill down too deep in the interest of time and for the fact that we've already discussed it with Matt and Andre, but there have been some significant changes in this budget, albeit somewhat positive for expat property investors, strangely enough. I'll run through a couple of the big points. So negative gearing, moving away from offsetting losses against the taxable income, instead against future capital gains. This is grandfathered, so it's going to be for properties purchased after budget night and to come into effect from 1 July 2027. Anyone that's held property prior to that can continue the existing arrangements. The one exception to this rule is for new builds. They are exempt from the change. They can continue to enjoy the previous benefit and can choose between both. This is obviously to promote housing and more build in Australia to increase supply. Now, for clients that are looking to purchase existing stock, this just may mean a strategy change in your property approach away from a yield-based strategy and more to a capital growth strategy. Okay, so happy to talk to that in more detail if you want to reach out. Most of the time you can structure your portfolio in a way where it benefits you depending on government policy. Okay, CGT is a win for expats, as they both mentioned, so we'll get to benefit from indexation rather than missing out on the 50% capital gains discount, which is brilliant. Trust lending, we don't see a lot of trust lending as expats for expats offshore. That's just because the resident director requirements for the corporate trustee. We do see a few every now and again, so if you are in a structure like that, feel free to reach out, and between Oriana and us, we can provide some advice. Okay, I suppose the good news here on the back of the budget and where we currently sit is that no changes that have been announced are going to materially impact your borrowing capacity or really impact your borrowing capacity as an expat. We do see some really strong numbers coming out of foreign jurisdictions based on the tax rates. We've got some really good expat lending partners that can use a relatively true tax rate for your servicing assessment, which just means higher borrowing capacities. Still some great lenders that can provide solutions, no additional loadings, no additional charges, the same product as a normal domestic client would get, but just tailored for your position. At the end of the day, Australia still has a supply issue, so the fundamentals are still in the market for property growth. For expats, the negative gearing has always been secondary to the growth in the asset value, and now with the treatment for CGT, it only works in our favour. Some things to consider: if you have been planning to purchase in a non-person entity structure like a trust, reach out before you do. It's probably good to get ahead of these changes. New builds, the clear low-hanging fruit now for property investors. The approach is very positive and supportive from the government. So, we can introduce you to partners that play in this space in terms of finding properties for you. As always, getting a pre-approval is key for you to be able to go to market with confidence. If you do find something you don't have finance sorted, it's going to be a slog to try to get you across the line. That's one of the pitfalls for expats, is that things do take a little bit longer. As much as we can rush the process, having a pre-approval just gives you that comfort. Pre-approvals typically last for up to 6 months. One that we always mention is not to get stung with the lazy tax. You need to regularly review your interest rates. Banks are great at not passing on full interest rate reductions for existing clients. So, annual reviews of your rate directly with the bank or speaking to a broker will only benefit you. And the last one, just don't wait for the market to drop. You can see the property growth over the last 5-10 years there. Perth alone, it's just going crazy. So property's a long game. It's better to be in than get left behind. So reach out if you need anything. Okay, on that, I'll hand back to Andre. Thank you. I think you're on mute, Andre.
How about I jump in? So
Sure.
we've got a few questions that have come through here. Looking into it, we've got 5 minutes, so we'll just fire through a couple. Just reading question here. Just want to ensure that I've grandfathered unit purchase in 2023. Will the negative gearing changes affect the treatment of the rental loss in 2027? No, all existing properties purchased prior to budget night are grandfathered under the new rules.
There was a question also that was submitted previously on how many properties, speaking to your point there, Matt, I think there was some rhetoric pre-budget that it was going to be capped at a certain number. That's proven false. So no matter how many investment properties you had pre-budget, you can still avail the pre-budget negative gearing approach.
Thanks, Sean. I think I've got my sound back. Question from Raymond. Raymond, how is the negative gearing looking for non-property assets? Interesting question. The budget itself has focused really more on property activities. So I dare say anything outside of the property asset class, it's still as per BAU, really, as per normal. So the budget itself is commenting more on the property sector and the use of negative gearing in that respect. But outside of the property assets, I dare say normal rules will still apply in terms of negative gearing.
There's one here as well. Do we need to have an official valuation done on the property as of 30 June 2026? Well, actually, very important. Grateful valuers and accountants and everyone else, but from 1 July 2027 is when the new capital gains rules come into play. So very important that you get a valuation then. So basically the way that it'll work for existing properties is that I'm going to speak to residents first because it's simpler. The 50% CGT discount will apply up to that 1 July 2027 date. And then from that date, the indexation application will take effect. As mentioned earlier, non-residents since the 8th of May 2012 have not been able to benefit from this 50% CGT discount. Not to go into the weeds of things, but it's important to actually have a valuation of that date as well, because you can apply sort of the pre-rules, post-rules after 8th of May 2012, and then these new rules coming into effect from July 27 next year. So important to have valuations at and around when these rules are changing.
I'll answer one last one in the interest of time here. Up from Matthew, are there any workaround ways to minimize tax from trust with corporate trustee, changing trustees, or beneficial distributions? A good question, Matthew. That is with regards to the tax treatment. This is applying to discretionary trusts. So what the government has indicated is that there are exemptions in terms of this minimum tax of 30% will not apply to certain types of trusts, such as fixed trusts, widely held trusts, testament trusts, such. So depending on what you're trying to achieve in terms of having a trust in the first place, you might want to review the type of trust structure that is. But if you want to maintain discretion over the trust distributions, then I'm afraid the 30% treatment will probably render that type of strategy redundant for now. All right then. Can we have the last slide? So just because it's just hit 2 o'clock at the moment. Thank you so much for your attendance, guys. I hope you actually found a lot of benefit from the content that we provided to you. Remember, it's at this moment, it's just a proposal. It's what the government is looking at putting through. But yes, it's there are certain things that you can actually do. One of them is to start a conversation with us and see where you're at the moment, and have a a review of your current structures and where you can actually improve it further to meet your objectives. The other part is to register for our next in-person events that we'll be having in the next week or two. We'll be looking forward to see you there, and we'll send through some of the information then. Okay, thanks, guys. Have a good afternoon, and I'll see you guys.
You.
Bye.
Thank you.
Bye.